Imagine you did the math perfectly. I mean, you tracked tens of millions of dollars across 3 continents.
Right.
You converted foreign currencies flawlessly using the exact daily spot rates. You reconciled foreign accounting standards to U.S. standards, paid your legal teams a small fortune, and filed your corporate tax returns right on time.
Sounds like a textbook perfect filing.
Exactly. But because you forgot to check a single, seemingly meaningless box at the top of page 1, the IRS hits you with an automatic $10,000 fine. Welcome to the brutal, unforgiving reality of international tax compliance.
Yeah, it is a system that, well, it does not grade on a curve. You don't get a gold star for trying your best when it comes to offshore assets.
No, you definitely don't. Welcome to another deep dive. Today, we are wading right into the deep end of global finance and tax law. We are exploring the labyrinth of Form 5471.
And we aren't just skimming the surface here.
No, we are specifically looking at the critical ownership and organizational schedules. That's schedules A, B, G, and O.
What's fascinating here is that, to the untrained eye, this form just looks like administrative paperwork. It's just a stack of boxes and grids.
Just another tax form to fill out.
Exactly. But to the IRS, these schedules are their ultimate diagnostic tool. They are the window into a multinational's entire global tax profile.
Wow.
Yeah, these pages map out exactly who owns what, where the money is geographically located, and how the entities are legally and financially structured to move capital around the world.
Okay, let's unpack this, because the stakes here are incredibly high. For you listening, whether you are a tax professional prepping for a grueling, busy season, or a CFO trying to understand your company's risk exposure.
Or maybe you're just an insanely curious mind wanting to understand exactly how international wealth is tracked by the U.S. government.
Right. You need to know how this machinery works. Failing to properly file these specific schedules doesn't result in a gentle warning letter. It triggers severe automatic monetary penalties for what the IRS calls Category 4 and 5 filers.
And remember that $10,000 penalty you just mentioned?
Yeah.
That's per form, per year, per foreign entity.
Wait, really? Per entity?
Oh, absolutely. So if a U.S. parent company has, say, 50 foreign subsidiaries and misses a required schedule on all of them,
oh, man.
you're looking at $500,000 in fines before an auditor even picks up the phone.
That is just terrifying. So this deep dive is your shortcut to avoiding those brutal compliance pitfalls.
And to understand how to avoid the pitfalls, we first have to understand why the IRS takes such an aggressive posture. It all revolves around a concept called a CFC.
Right, a controlled foreign corporation. Let's define that clearly, because it is the linchpin of this entire reporting regime.
It really is.
So a CFC is a foreign corporation where U.S. shareholders own more than 50% of the total voting power of all classes of stock, or the total value of the stock, on any single day of the annual accounting period.
I want to highlight the word "or" in that definition. Voting power or value.
Okay, so it doesn't have to be both.
Exactly.
Yeah.
You could have a class of stock that gives you absolutely zero voting rights.
Right.
I mean, you can't elect a single board member. You have no say in how the foreign company is run.
Right.
But if your non-voting shares represent more than 50% of the financial value of the company, congratulations, you've got a controlled foreign corporation.
And if you have a CFC, the IRS demands to know everything about its internal workings.
Everything. So the IRS has this rigid penalty case file process. It starts with what they call Step 1, verify fact of filing.
Right, where the examiners, and more often their automated systems, review the forms on their face for completeness. And the things that trigger a massive failure are wild, like, for instance, missing item B.
Yeah, item B is just a simple set of checkboxes at the top of the first page indicating your category of filer.
Just a checkbox. And if you miss that, the IRS says they can't even determine which schedules are required. Or missing item C, which is simply entering the percentage of voting stock you hold.
Or missing item 1A, the name and address of the foreign corporation itself.
It sounds elementary. You would think, who forgets to put the name of the company on the tax return?
But people do. I mean, you'd be surprised.
Here's where it gets really interesting, though. You could have spent 80 hours reconciling foreign currencies and building out a beautiful balance sheet on the later pages of the form. But if you leave item B blank, your form is deemed essentially unfiled.
Yeah, there is a very specific systemic reason for this lack of mercy. The IRS processes millions of these complex international returns. They do not have a human tax attorney sitting down with a cup of coffee to read every single page of your submission to deduce what you meant to do.
Right, it's all automated now.
Exactly. Their automated scanners and risk analysis algorithms rely entirely on that item B category to cross-reference the required schedules. If you don't tell the system whether you are a category 3, 4, or 5 filer, the machine literally cannot compute if you are supposed to attach Schedule A, Schedule G, or Schedule O.
It just crashes the system.
Without that key, the data is useless to their risk models.
Yeah.
The system breaks.
So it's not just a bureaucrat being pedantic. You are breaking the machinery they use to audit you.
That's exactly it. And this brings us to a monumental legal battleground in tax compliance. The concept of substantial compliance versus strict interpretation.
Oh, this is a big one.
Yeah, for decades, taxpayers would go to tax court and argue, listen, I gave you 95% of the information. You have the balance sheet, you have the income statement. I substantially complied with the law. You can't hit me with a $10,000 fine over a missing checkbox.
They want it to be graded like a high school test, and 95 is an A.
Right, the aggregate approach.
So,
But the IRS and the courts pushed back hard. If we look at the historical legal guidance, specifically a 1997 Field Service Advice Memo FSA, 1997 WLO3 3381431, the IRS analyzed Congress's intent when they drafted these penalty statutes.
and what did they find?
The memo concluded that Congress absolutely did not intend for an aggregate approach to apply here. Substantial compliance cannot be determined by weighing the good information against the missing information.
So you can't just say, well, most of it is there.
No, it must be determined on a strict, significant item by significant item basis.
So if a significant item is missing, the whole thing fails, even if the rest of it is perfect.
Yes, and there is further, very detailed guidance in a Chief Counsel Advice Memo, specifically CCA 2004-29007.
Okay, CCA 2004-29007. What did the Chief Counsel have to say?
Well, to be precise, this CCA was technically issued regarding Form 5472, which is the mirror image form dealing with foreign-owned U.S. corporations rather than U.S.-owned foreign corporations.
Gotcha.
But the legal penalty analysis applies equally to Form 5471. The CCA outlined a facts and circumstances test with 7 specific factors to weigh when deciding if a form is substantially incomplete.
What kind of factors are we talking about?
Things like the magnitude of the underreported or overreported transactions, whether the omissions were a pattern or just an isolated clerical error.
That makes sense.
But most importantly, whether the missing information hinders the IRS's ability to actually determine the correct tax liability. If you omit the exact legal entity structure, the IRS cannot determine if you are inappropriately shifting profits to a low-tax jurisdiction. Therefore, the form is substantially incomplete.
So the core takeaway is that errors on the face of the form are fatal. Omit the category, omit the percentage owned, omit the name of the foreign corporation, and it's a penalty.
Yep, an automatic penalty.
But beyond just blank boxes, there are other common reasons for non-compliance that honestly just sound like taxpayers trying to take lazy shortcuts.
Oh, human nature always shines through on tax forms. One of the most classic shortcuts that gets immediately flagged for a penalty is writing, "Information will be furnished upon request," or "available upon audit" across the schedules.
I can just imagine a stressed-out accountant at 2 a.m. on the night before the deadline just typing, "I'll show you if you ask," into a text box.
It happens way more often than you'd think.
Yeah.
But you really can't do that. The entire legislative purpose of an information return like Form 5471 is to provide the data up front so the IRS's algorithms can decide if they need to audit you.
If you hide the ball, you defeat the purpose of the form.
Exactly.
What about making your own forms?
Oh, that's another massive trigger. Providing unapproved, computer-generated forms that don't strictly conform to the IRS layout.
Wait, so you can't just export a proprietary spreadsheet from your company's internal accounting software and staple it to the back of the return?
Absolutely not. The IRS scanners need the data fields in exact spatial coordinates.
Okay, and here's one that seems like a massive headache for corporate controllers. Providing consolidated financial statements for 2 or more foreign corporations instead of separating them out.
This is a huge issue. Let's say a U.S. parent has a holding company in the U.K., and that U.K. holding company owns 5 different operating subsidiaries across Europe.
Right.
For the company's internal reporting to its shareholders, it naturally consolidates all those European operations into one clean financial statement.
Sure, investors just want to see the bottom line of the European division. They don't care about the granular details.
Right. But the IRS doesn't care about your investor relations. The IRS needs entity-by-entity reporting. They want to see the specific, standalone financial health, the exact cash balances, and crucially, the intercompany transactions of each individual subsidiary.
Why are intercompany transactions so important to them?
Because if subsidiary A in France is lending money to subsidiary B in Ireland, a consolidated financial statement completely eliminates that intercompany loan. It vanishes.
Oh, because it cancels out on the consolidated balance sheet.
Exactly. But to the IRS, that loan might represent taxable U.S. property or a disguised dividend. Consolidating the financials hides the exact flow of money that Form 5471 was designed to expose.
Okay, so the table is set. The IRS is not playing around. They need the form filed timely, they need the face of the form to be pristine, and they need granular entity-by-entity data.
You've got it.
And the very first thing they want to know, before they look at a single dollar of profit, is ownership. Who actually holds the keys to this foreign entity? That leads us straight into Schedule A and Schedule B.
I like to call this the DNA of the corporation. If Form 5471 is the diagnostic X-ray, Schedules A and B are the genetic sequencing.
Let's start with Schedule A. The schedule focuses entirely on the stock of the foreign corporation. Under Title 26 of the Code of Federal Regulations, Section 1.6038-2, you are required to report the number of shares of each class of stock outstanding at the beginning and the end of the annual accounting period.
It sounds so incredibly straightforward, doesn't it?
Yeah.
Just tell us how many shares exist.
It really does.
But practically, for a tax professional, this is where the nightmare of cross-border compliance truly begins.
Why? I mean, a share is a share, isn't it?
Not at all. You are dealing with foreign legal jurisdictions that have entirely different concepts of corporate ownership than Delaware corporate law. Often there is poor, or sometimes completely non-existent, legal documentation of stock classes in certain developing nations.
Oh, wow.
Yeah, or you might be dealing with a foreign entity type that doesn't actually issue shares in the way we think of them.
Like what? Give me an example.
Think of a German GmbH, a Gesellschaft mit beschleunigter Haftung. It's roughly equivalent to a U.S. LLC. They don't typically issue stock certificates that you hold in your hand.
Okay, so how do you prove ownership?
Ownership is represented by business shares, or Geschäftsanteil, which are documented in a commercial register. Translating the exact legal rights, the par value, the voting power, and the dividend preferences of those foreign interests into U.S. tax concepts of class of voting common or preferred stock is an exercise in comparative international law.
And the IRS demands you track all of that on Schedule A. You have to lay out the par value, the exact number of shares, and any changes that happen during the year.
Yes, because you cannot determine if a company is a controlled foreign corporation until you clearly define what the denominator is. You need to know the total universe of stock before you can figure out who owns 50% of it.
Makes total sense. And once you've defined that universe on Schedule A, you have to list the exact planets orbiting that sun on Schedule B.
That's a great way to put it.
Schedule B is where you name names. It is split into parts. Part 1 lists the U.S. shareholders, and Part 2 lists the direct shareholders. The instructions dictate exactly who must file this, specifically Category 1A, 1C, 3, 4, 5A, and 5C filers.
Which, in practical terms, means almost everyone with a significant reporting requirement. If you are deeply involved in this foreign company, you are detailing your interest here.
But here's where we leave the realm of simple logic and enter the matrix, because the concept of owning a share in U.S. international tax law is not just about holding a piece of paper with your name on it. We have to talk about IRC Section 958.
The attribution rules. This is the section of the Internal Revenue Code that keeps international tax planners awake at night.
Let's break this down slowly for everyone listening. The rules for determining stock ownership under Section 958 fall into 3 distinct buckets. First, we have direct ownership. This is governed by Section 958, subsection A, paragraph 1.
Right.
This is the easiest one. I buy a share of a UK company with my own money. The share is registered in my name. I directly own it.
Simple, undeniable economic reality.
Exactly. Then we step into the second bucket, indirect ownership. This is Section 958, subsection A, paragraph 2. This covers stock owned directly or indirectly by or for foreign corporations, foreign partnerships, or foreign trusts. The law says this stock is considered to be earned proportionately by its shareholders, partners, or beneficiaries.
So this is looking through the corporate veil. If you own 100% of a holding company in the Cayman Islands, and that Cayman company buys shares in a Swiss bank, the IRS says, we aren't fooled by the Cayman middlemen. You indirectly own those Swiss bank shares.
Okay, that makes logical sense. It's a chain of ownership through successive tiers. The indirect attribution generally stocks with the first U.S. person in the chain of ownership. So if the money flows up to a U.S. entity, the buck stops there for reporting purposes.
Exactly. Direct and indirect ownership are about tracing actual economic investment. Your money was used to buy the asset, even if it passed through a few corporate toll booths along the way.
But then we reach the third bucket, and this is where the logic feels like it's bending backward. Constructive ownership.
Buckle up.
This is dictated by Section 958, subsection B, which pulls in the rules from Section 318, subsection A.
Sure.
So what does this all mean? Let me try an analogy here.
Please do.
Constructive ownership is like tracing your family tree and suddenly discovering you are financially responsible for the debts of a third cousin you've never met simply because your grandfather signed a piece of paper 40 years ago.
Wow.
Right. It means you might own a company on paper for tax reporting purposes without ever having bought a single share directly, and without even owning it indirectly through a holding company you control. You own it strictly because someone related to you owns it, or an entity you are tangentially associated with owns it.
That is a phenomenal analogy. It is exactly a corporate family tree. The IRS built the constructive ownership rules because clever tax planners kept finding ways to hide assets by just shuffling them laterally.
Shuffling them laterally, how so?
Well, if you want to hide a foreign factory from the IRS, you might just put the shares in your spouse's name or your child's name, or you might have a sister company hold the asset. Constructive ownership rules pull all those lateral branches back to you. The rules attribute ownership upwards, downwards, and sideways across family members and related entities.
Man. Okay, let's dig into the mechanics of these complex chains, specifically upward attribution versus downward attribution. Upward attribution sort of makes sense. A parent company is deemed to own what its subsidiary owns.
Right.
But the rules specifically call out downward attribution to corporations under Section 318, subsection A, paragraph 3.
This is where it gets highly counterintuitive. If we connect this to the bigger picture, Section 318, subsection A, paragraph 3, dictates that if 50% or more in value of the stock in a corporation is owned directly or indirectly by or for any person, then that corporation is treated as constructively owning whatever stock that person owns.
Wait, let me make sure I'm hearing this right. The corporation is treated as owning what its own shareholder owns? That feels entirely backward. A subsidiary doesn't own its parent's assets.
In the real economic world, you are absolutely right. A subsidiary does not own its parent's assets. But in the matrix of Section 318, downward attribution, the ownership flows down from the shareholder into the corporation.
That is wild.
Yeah, the corporation absorbs the tax identity and the ownership profile of its majority owners. However, the law provides a crucial restriction. Stock that is attributed downward to a corporation cannot be reattributed back out to make another shareholder the constructive owner. It's a one-way street down into the corporate entity.
Okay, we absolutely need a hypothetical scenario to make this concrete. This is too abstract. The source material actually gives us a fantastic, detailed example to walk through. So for everyone listening, imagine a massive whiteboard. We are going to draw this out.
Okay, I've got my mental dry erase marker ready.
We start at the top, or rather the side. We have U, which is a domestic U.S. corporation, an American business. U owns exactly 15% of the stock of FP, which stands for foreign parent. FP is a massive international conglomerate based overseas.
Got it. Domestic Corporation U owns a 15% minority stake in foreign parent FP.
Now, let's look at FP's holdings. This foreign parent wholly owns two different subsidiaries. It owns 100% of D, which is another domestic U.S. corporation, and it owns 100% of FS, which is a foreign subsidiary.
Okay.
So, to recap the drawing, U owns a piece of FP, and FP owns all of D and all of FS. D and FS are sibling companies under the foreign parent.
A classic triangular corporate structure branching out from the foreign headquarters.
Now, here's the bombshell. The rules state that FS, the foreign subsidiary, is a foreign-controlled CFC, a controlled foreign corporation. But how is that mathematically possible? FP, the parent, is foreign. U, the only American entity with real ownership, only owns 15% of the parent. Where on earth is a 50% U.S. ownership required to trigger CFC status?
This is where the terror of downward constructive ownership strikes. We have to look at the sibling relationship. Remember, FP, the foreign parent, owns 100% of D, the domestic U.S. corporation.
You're right.
Under the downward attribution rule we just discussed, D is treated as constructively owning the stock that its parent, FP, owns.
Because FP owns the majority of D, D absorbs FP's ownership profile.
Exactly. And what does FP own? FP owns 100% of FS, the foreign subsidiary. Therefore, by operation of tax law, D, the domestic U.S. corporation, is treated as constructively owning 100% of its sibling, FS.
Oh, wow.
And because a U.S. person corporation D constructively owns more than 50% of FS, FS instantly becomes a controlled foreign corporation.
That is genuinely mind-bending. Let's really pause and think about this. Corporation D doesn't own a single share of FS. D didn't invest in FS. D has no economic right to the profits of FS.
None at all.
They might not even operate in the same industry. They're just sibling companies that happen to share the same foreign parent. But because of downward attribution, D is treated as owning its sibling, dragging that sibling into the U.S. tax net as a CFC.
It feels aggressive, but the IRS designed it this way to prevent D-control strategies. Before these specific rules were tightened, a U.S. parent could just invert, put a foreign holding company on top of itself, and suddenly claim all its foreign subsidiaries were no longer U.S.-controlled. Downward attribution ensures that if a U.S. entity is in the same corporate family tree under common control, the foreign entities remain heavily monitored.
It gets even more complicated. Now that we've established FS as a CFC, we have to figure out who actually has to file the Form 5471 for it.
Right. Who has the legal burden to do the paperwork?
Let's look at D first. D constructively owns 100% of FS. The rules classify D as a U.S. shareholder of FS because it crosses the 10% threshold via constructive ownership. Because D doesn't own it directly or indirectly, but only through these related family tree rules, D is classified as a related constructive U.S. shareholder. That specific designation makes D a Category 5C filer.
Okay, so D is on the hook. D has to file the form.
But what about U, the domestic corporation that kicked this all off by owning 15% of the foreign parent, FP?
Well, let's trace U's economic reality. U indirectly owns a piece of FS. U owns 15% of FP, and FP owns 100% of FS.
Okay, so through the chain of indirect attribution, U indirectly owns 15% of FS.
Yes, and since 15% is greater than the 10% threshold required to be a U.S. shareholder, U is absolutely on the hook as well. The rules classify U as an unrelated Section 958, subsection A U.S. shareholder, which makes it a Category 5B filer.
So both D and U have to file a massive Form 5471 for this foreign subsidiary.
They do.
And the instructions specifically note a brutal reality. D and U cannot just get together and file a single joint form. Why? Because a Category 5B filer, which is U, and a Category 5C filer, which is D, do not have the exact same schedule filing requirements. They have to file completely separate returns reporting on the exact same foreign company.
This hypothetical perfectly illustrates why international tax compliance is not something you dabble in. You cannot just look at the stock certificates in the corporate safe to know who files. You have to run the entire global organization chart, every entity, through the Section 958 attribution matrix to see what hidden constructive ownership paths light up like a Christmas tree.
To show just how fragile and volatile these thresholds are, let's contrast that with example 2 from our sources. We're going to use the exact same whiteboard drawing. FP owns 100% of D and 100% of FS. The only difference in this scenario, Corporation U only bought a 9% stake in FP instead of 15%.
A seemingly minor economic shift, just a 6% difference in holding at the parent level.
Right. But watch the dominoes fall. FS is still a foreign-controlled CFC. Why? Because the downward attribution from FT to D hasn't changed. FP still owns D, so D still constructively owns 100% of FS.
The sibling relationship still poisons the well.
Exactly. But what about U? Because U only owns 9% of FP, it indirectly owns only 9% of FS.
And this is where the threshold saves them. Because 9% is strictly less than the 10% statutory threshold to be considered a U.S. shareholder, U has absolutely no filing requirement for FS. They fall completely off the IRS radar for Form 5471 purposes.
But wait, let's look at D again. D still constructively owns 100% of FS, so D is still a Category 5C filer, right? They still have to do all the paperwork.
This raises a really important nuance, and the legal framework provides a fascinating exception here. Yes, D constructively owns 100%. But D does not own any stock within the strict meaning of Section 958, subsection A, which means D has zero direct or indirect economic ownership. It is purely a phantom constructive owner.
A phantom owner.
Yes. And the rules state that a Category 5 filer does not have to file if they are required to furnish the information solely because of constructive ownership from a non-U.S. person. And D, they don't own any direct or indirect interest themselves. because D only owns FS constructively through its foreign parent, FP, and D doesn't own a single real economic share directly or indirectly. D is entirely exempt from filing.
Hang on, let me make sure I understand the whiplash here. In example 1, when you owned 15%, D had to file as a Category 5C. But in example 2, just because U drops to 9%, suddenly D doesn't have to file. How does U's ownership affect D's exemption?
Let me clarify that, because it's the most tangled part of the law. D's exemption isn't actually triggered by U dropping to 9%. D is generally exempt under the related constructive shareholder exception if the U.S. person through which they constructively own the stock files a form. But in this specific case, the constructive ownership is coming down from a foreign person, FP. The specific legal wording says D doesn't have to file because D does not own, within the meaning of Section 958, subsection A, stock in FS, a foreign-controlled CFC.
Wow.
What this highlights is that while constructive ownership is incredibly powerful, it literally creates the CFC status out of thin air. The IRS recognizes that forcing a domestic sibling company to report on a foreign sibling company when there is absolutely no U.S. parent in the mix is an impossible administrative burden. D would have no legal right to demand the financial records of FS. So the law creates the CFC status to prevent abuse, but turns off the reporting requirement for D because D has no real economic linkage.
It is a breathtaking labyrinth, and Schedule B is the specific page where you have to lay all of this out for the IRS. You have to list every single U.S. shareholder and then meticulously break out their direct percentages, their indirect percentages, and their constructive ownership percentages.
You really do.
You have to mathematically prove the matrix. It is incredibly common to have missing minority U.S. owners or complex chains involving foreign trusts and partnerships that obscure the math. You literally have to draw the treasure map for the IRS.
And once you have drawn the map of exactly who owns the entity, the IRS's very next question is, what is this entity actually doing? How is it operating? Which brings us directly to Schedule G.
Let's unpack Schedule G. The title is just Other Information, which sounds incredibly benign. It essentially looks like a very long, multi-page questionnaire. It just asks a series of yes or no questions about the foreign corporation.
But I promise you, these are not casual survey questions. They are highly targeted, laser-focused probes looking for specific tax triggers. The IRS is hunting for events that allow them to pull foreign income back into the U.S. tax net.
We're talking about questions regarding the entity's functional currency, earnings and profits deficits, which we need to define, basis adjustments under Sections 959 and 961, distributions and reorganizations. You are answering these yes or no questions to show the auditor exactly how this specific CFC fits into the multinational group's broader global tax profile.
Let's pause and clarify earnings and profits, or E&P, because it's the holy grail of international tax. We throw around E&P a lot.
Right. Wait, how is E&P different from just the retained earnings sitting on a normal corporate balance sheet? If a company has $1 million in the bank, isn't that their profit?
Not in the eyes of the IRS. E&P is a pure synthetic U.S. tax concept. It doesn't exist in accounting textbooks. Retained earnings on a balance sheet are calculated using generally accepted accounting principles, or GAAP.
Okay.
But GAAP allows companies to take massive non-cash deductions, like accelerated depreciation on a factory, which artificially lowers their retained earnings. If a company used GAAP retained earnings to dictate their tax reality, they could tell their shareholders they are highly profitable, while simultaneously telling the IRS they have zero profits, and therefore any dividends they pay out should be a tax-free return of capital.
Ah, so they could have their cake and eat it too.
Exactly. So Congress invented earnings and profits. E&P is designed to measure a corporation's true economic ability to pay a dividend. To calculate E&P, you start with taxable income, and then you add back all those artificial tax deductions. You add back tax-exempt municipal bond interest. You adjust the depreciation schedules.
It sounds like a grueling calculation.
It is. And Schedule G is obsessed with tracking the E&P of these foreign entities, because the moment E&P is distributed to a U.S. shareholder or invested in U.S. property, it becomes taxable.
And the major pitfall on Schedule G is that tax preparers often treat it like a mindless checkbox exercise. It's the end of busy season, you're exhausted, so you just check no down the line.
A very dangerous game.
Right. Because if you check no to a question asking if the company underwent a reorganization, but Schedule O later in the return documents a massive corporate acquisition, the IRS automated systems will immediately flag the internal contradiction and kick out the return.
The left hand must absolutely know what the right hand is doing on this form.
But the biggest news for Schedule G comes from the brand new legislative updates. If we look at the instructions for Form 5471, revised December 2025, there is a major congressional update. The One Big Beautiful Bill Act, affectionately known as OBBA, passed in July 2025.
OBBA.
Yes.
A truly seismic piece of legislation for international tax planners.
Let's detail the new rules under OBBA. The law states, for a tax year of a specified foreign corporation, or SFC, beginning after November 30, 2025, the SFC may not have a tax year beginning 1 month earlier than the majority U.S. shareholder year.
To understand why Congress did this, you have to understand the classic timing loophole they were shutting down. Historically, if a massive U.S. parent company had a standard calendar tax year ending December 31st, they would strategically set up their foreign subsidiary to have a tax year ending exactly 1 month prior November 30th.
Why go through the administrative hassle of having mismatched calendars? What is the tangible advantage of that 1 month difference?
It's all about the time value of money and the magic of tax deferral. Let's walk through the calendar. Imagine that foreign subsidiary closes a massive deal and earns $10 million in income in December of year 1.
Okay, December of year 1.
Because the subsidiary's tax year already ended on November 30th of year 1, that December income actually falls into the subsidiary's next tax year, the year ending November 30th of year 2.
Okay, so the income belongs to year 2 for the subsidiary.
Right. Now, when does the U.S. parent have to report and pay tax on that year 2 foreign income? They don't report it until they file their own U.S. tax return for year 2. And with standard corporate filing extensions, the U.S. parent might not actually file that year 2 return until October 15th of year 3.
Wow. Wait, really? So income that was actually earned in December of year 1 isn't taxed in the U.S. until almost the end of year 3?
Precisely. By simply misaligning the corporate calendars by a single month, multinationals were effectively pushing their tax liability out by almost a full year, keeping that cash invested and earning interest. When you multiply that deferral across billions of dollars of global revenue, the U.S. Treasury was bleeding revenue.
So OBBA forcefully shuts that down. Congress said the party is over, no more 1 month lag. You must align the tax years to prevent that aggregate deferral of income.
Exactly. But whenever you force thousands of complex multinational companies to suddenly change their tax accounting periods midstream, you create absolute chaos. What happens to the dividends paid during that gap period?
That's where the transition rules come in. The instructions mention a pro rata share transition rule, pointing to Notice 2025-75. It dictates that certain dividends paid by a CFC during the shift are not treated as dividends for the purposes of applying specific anti-abuse rules under Section 951.
It's a temporary shock absorber. The transition rule is designed to ensure that as companies abruptly shorten or lengthen a tax year to comply with OBBA, income isn't accidentally double counted by the IRS or permanently lost in the shuffle.
And Schedule G itself has a brand new question specifically because of these 2025 changes. Question 3B. It asks if the foreign corporation has one or more qualified business units, or QBUs, with a functional currency that is different from its owner. If the answer is yes, you are now required to attach an entirely new form, Form 8964-TRA.
Let's define a QBU, because it's a vital concept. A qualified business unit is essentially a distinct and recognized trade or business within a larger corporation that maintains its own separate books and records.
Could you give us an example?
Sure. Imagine a French CFC that manufactures cars. The French entity operates in euros, but they have a dedicated sales branch operating in Tokyo.
Oh.
That Tokyo branch has its own bank accounts, its own employees, its own separate accounting ledger, and it operates entirely in Japanese yen. That Tokyo branch is a QBU.
Oh, I see.
The IRS wants Form 8964-TRA attached to specifically track the complex currency translation gains and losses between the yen branch and the euro parent before it ever reaches the U.S. return.
Which perfectly transitions us to what I consider the most fascinating and frankly the most terrifying part of this form, reporting exchange rates. I was reading this specific section of the instructions, and I have to say, it blew my mind a little bit.
You're talking about the divide by convention.
Yes. The instructions emphatically state that when translating financial amounts from a foreign functional currency into U.S. dollars on the form, you must use a divide by convention, and you must round that rate to at least 4 decimal places.
They are very serious about that.
And here's where it gets really interesting. The instructions actually scold the taxpayer. They specifically say, do not report the exchange rate as the number of U.S. dollars that equal 1 unit of foreign currency. It is the exact inverse. You must report it as the units of foreign currency that equal $1.
Right.
Why is the IRS so incredibly specific about this math? Why are they demanding we divide instead of multiply? Mathematically, shouldn't it get you to the same place?
Well, in a perfect mathematical universe, yes. But in the real world of foreign exchange, or Forex, precision is everything. You can quote an exchange rate either way. You can quote euro to dollar or dollar to euro.
Right.
The problem arises with rounding. If the IRS allowed taxpayers to just multiply by a decimal, say multiplying by 0.00075 to convert Japanese yen to dollars, small rounding differences at the fourth or fifth decimal place seem insignificant.
Sure, fractions of a penny.
But when you are a multinational corporation, multiplying that rounded rate across 100 billion yen of revenue, a rounding error at the fourth decimal place creates massive million-dollar discrepancies in the U.S. tax liability.
Oh man, it creates phantom profits or phantom losses just from the math.
Exactly. By forcing every single taxpayer to strictly use a divide by convention, for instance, mandating that you divide the yen amount by 133.33333 to arrive at dollars, it creates a mathematically tighter, uniform standard. It standardizes the data input, so their automated risk analysis systems can cross-check the math flawlessly.
And they demand it be rounded to at least 4 decimal places. In fact, the rule says you must round to more than 4 places if a failure to do so would materially distort the exchange rate or the equivalent amount of US dollars.
And if we connect this back to the bigger picture, think back to our earlier discussion about the penalty case files and substantial compliance.
The $10,000 fine for a missing checkbox?
Right. Now let's apply that strict liability to this math. Let's look at the legal guidance regarding errors that happen beyond just the face of the form. The Chief Counsel Advice Summary we discussed explicitly advised that significant pieces of required information include balance sheet and income statement amounts that are properly translated into U.S. currency.
So if you mess up the divide by convention, if you multiply instead of divide.
If you multiply by 0.85 instead of dividing by 1.1764, and your U.S. dollar equivalent amounts are materially distorted by a few $100,000, the IRS will not view that as a simple clerical math error.
They won't.
No. Under the strict interpretation of substantial compliance, they can rule that your entire income statement is substantially incomplete. You fail to file a complete Form 5471, and boom, the $10,000 penalty applies.
All because you use the multiplication key on your calculator instead of the division key? That is genuinely terrifying.
It is a strict liability environment. The substantial compliance test must be applied on a significant item by significant item basis. An income statement submitted with the wrong currency conversion protocol is a massive failure of a significant item.
Okay, so we've established that the IRS expects absolute perfection. They expect perfect matrix-level attribution on Schedule B. They expect perfect GAAP-reconciled financials. They expect perfect exchange rates on Schedule G divided out to 4 or 5 decimal places.
Yes, perfection is the baseline.
But let me ask you the obvious real-world question.
Yeah.
What if you literally cannot get the information? What if it is impossible?
That is the daily reality for thousands of U.S. taxpayers invested abroad.
Which brings us to the pressure release valve of this entire system, the Alternative Information Safe Harbor. This centers around a critical piece of guidance, Revenue Procedure 2019-40.
This revenue procedure was an absolute lifeline thrown by the IRS to a very specific, highly vulnerable group of taxpayers.
Let's set up a scenario to understand why this was necessary. Imagine you are a U.S. investor, a moderately wealthy individual, or a mid-sized private equity fund. You purchase, say, a 12% minority stake in a massive privately held manufacturing company based in Munich, Germany.
Okay, a 12% stake.
You are classified as a Category 5B filer and unrelated U.S. shareholder. Because you crossed that 10% threshold, the IRS demands you file Form 5471. You need the Munich company's income statement, their balance sheet, their highly complex E&P calculations, all of it perfectly converted to U.S. GAAP standards.
That is the legal requirement, yes.
So you pick up the phone, you call the CFO of this multi-billion-dollar German corporation, and you say, Guten Tag, I own 12% of your company. I need you to completely overhaul your internal accounting systems, hire a U.S. tax firm, redo your books to U.S. GAAP, and hand over all your internal proprietary data so I can file my personal U.S. tax return.
Good luck with that.
Right. What is that CFO going to say to you?
That CFO is going to laugh hysterically, tell you you are out of your mind, and hang up the phone. A 12% minority shareholder simply does not have the legal voting power or the corporate leverage to force a massive foreign corporation to spend millions of dollars overhauling its accounting department just to satisfy one minority owner's U.S. tax compliance. It's economically impossible.
Exactly. But for decades prior to 2019, the IRS basically plugged its ears and said, not our problem. The statute says you have to file the form, get the U.S. GAAP data, or face the $10,000 penalties.
Fair.
They were legally setting minority owners up to fail.
It was an incredibly unjust application of the law, and the tax community lobbied aggressively for relief. That's where Revenue Procedure 2019-40 comes in.
Yeah.
It finally provides a legal safe harbor.
So how does it work?
If you look at page 1 of the modern Form 5471, there's now item F, a checkbox indicating you are using alternative information,
Yeah.
and item G, where you enter a specific 2-digit code.
So you check the box and say, I did my best, here's what I have. But the IRS didn't just give taxpayers a blank check to submit garbage data, did they?
No, the IRS rarely gives a blank check. What's fascinating here is the strict, rigid hierarchy of these alternative information codes. They created a waterfall of acceptable data. You have to start at the top and prove you can't get it before you can move down to the next level.
Let's walk down that waterfall. Code 01 is audited standalone financial statements prepared in accordance with U.S. GAAP. Well, obviously, if you have that, you don't really need a safe harbor. That's perfect compliance.
Right. Code 01 is the gold standard.
If you can't get that, you move to Code 02. Audited standalone financials prepared in accordance with International Financial Reporting Standards, known as IFRS, or the local country's GAAP.
So in your Munich example, if the CFO hangs up on your U.S. GAAP demand, but later emails you their official audited German commercial financials, you can use those under Code 02.
What if they won't even give you the audited version because it contains proprietary strategic data? You drop to Code 03, unaudited standalone financials. And if they won't even give you that, you hit the bottom of the barrel with Code 04. The basic records used by the foreign corporation strictly for their local tax reporting.
But the crucial unforgiving rule here is the concept of readily available. You can only use a lower tier code if the higher tier codes are legally or practically out of your reach.
So you can't just jump to Code 04 because it's easier.
Exactly. The instructions explicitly state, information described in Code 03 unaudited financials qualifies as acceptable alternative information only if the information described in Codes 01 and 02 is not readily available. You must be prepared to prove to an IRS auditor that you requested the audited books, that you were denied, and that you lacked the legal control to force the issue before you settle for the unaudited books.
So, bringing this full circle, how does this safe harbor actually protect you, the listener, from those massive $10,000 penalties we opened the show with? If you're that 12% minority owner in Munich, how does this level the playing field?
It fundamentally rewrites the definition of substantially complete for your specific tax return. If you properly qualify for the safe harbor and you correctly use Code 03 because you could genuinely only obtain unaudited financials, the IRS is legally barred from penalizing you for failing to provide perfect U.S. GAAP financials.
Wow, so it actually works.
Yes. The revenue procedure forces the IRS to accept the alternative information as fully satisfying the rigorous requirements of Section 964. It is an impenetrable legal shield against the penalty case file algorithm.
That connects perfectly back to our earlier matrix of ownership discussion on Schedule B. The IRS isn't blind. They know these wildly complex minority stake ownership chains exist.
Oh, they know.
They know that constructive downward attribution forces U.S. taxpayers into impossible compliance traps, where they have reporting duties but no actual corporate control. The alternative information safe harbor is the pressure release valve that stops the entire reporting regime from collapsing under its own weight of impossibility.
Exactly. Without Revenue Procedure 2019-40, no U.S. person could ever safely invest as a minority partner in a foreign enterprise. It would be financial suicide.
Okay, we have covered an immense amount of ground. We've navigated the unforgiving face of the form, mapped the DNA of constructive ownership, calculated the functional currency math down to the fourth decimal, and found the safe harbor for minority owners.
It's been quite a journey.
Now let's explore the final piece of this puzzle. Schedule O, documenting the evolution of the entity.
Schedule O is fundamentally different from the rest of the form. It is the historical record. The formal title is Organization or Reorganization of Foreign Corporation and Acquisitions and Dispositions of its Stock.
The other schedules we've discussed, A, B, G, are annual snapshots. You take a picture of the company on December 31st. But Schedule O is a motion picture. It tracks the events.
Exactly.
This schedule is required under IRC Section 6046, and the key threshold here is 10%. If a U.S. person acquires or disposes of 10% or more measured either in total value or in voting power of the outstanding stock of a foreign corporation, they trigger a Schedule O filing requirement.
And it's crucial for practitioners to remember that this isn't an ongoing annual requirement. It is highly transactional. You only file Schedule O for the specific tax year in which the triggering corporate event actually occurred. If nothing happens for 10 years, you don't file Schedule O for 10 years.
The instructions detail exactly what constitutes a reportable reorganization. It states that it means a transaction described in Section 368, subsection A, paragraph 1, as well as anything having the same effect.
Section 368 of the tax code is the beating heart of U.S. corporate reorganization law. It governs statutory mergers, stock-for-stock exchanges, complex asset acquisitions, spin-offs, split-offs, you name it.
So by referencing Section 368 and adding or anything with the same effect, the IRS is casting the widest possible net.
Exactly. If the fundamental structure of the foreign company shifts in any meaningful way, the IRS demands a detailed map of the before and the after.
Let's bring this to life. Schedule O, Part 2, is broken into specific sections for different types of events. Section C is for acquisitions. Section D is for dispositions. Section F handles additional information. Let's look at a hypothetical scenario to see how this traps people. Let's imagine a taxpayer named Alex.
Okay, let's look at Alex's tax reality.
Alex is a U.S. citizen. Way back in 1999, during the dot-com boom, he purchased 10,000 shares of common stock in foreign corporation X. He's held on to those shares for decades, quietly reporting them. But now, it is July 1st, 2025. Alex's daughter is buying a house, and he is feeling generous. He decides to make a gift of 5,000 shares of Corporation X directly to his child.
A very generous father.
Absolutely. But let's look at this from Alex's perspective. He might think, well, I'm just helping my daughter out. It's a family gift. No money changed hands. I didn't sell anything on the open stock exchange, so I didn't trigger any capital gains. I'll just handle it on my estate planning. I don't need to mess with my complex international corporate tax returns for a gift.
And that logical common sense assumption would be dangerously, expensively wrong.
Because he reduced his overall holding in the foreign corporation by disposing of stock, he crosses the reporting threshold. Even though no cash was generated, he legally disposed of an asset. Therefore, he is legally required to complete Schedule O, specifically Section D, which covers the disposition of stock. If you look at how the IRS forces you to fill this out, it is a brilliantly designed trap.
Walk us through the trap.
Column A asks for his name. Easy. Column B asks for the class of stock. He enters common. Column C asks for the exact date of the transaction, July 1st, 2025. Column D asks for the method of disposition. This is where he has to declare his intentions. He enters gift.
That is the linchpin column. The IRS needs to know explicitly if this was a taxable cash sale, a tax-free corporate reorganization, or a familial gift, because that single word dictates the tax consequences across his entire overarching tax return, including his lifetime gift tax exemption limit.
Exactly. Then he hits column 1, where he enters 5,000 for the number of shares disposed of. But here is the most critical part of the entire form. Column F demands the amount paid or value given. For a gift to his daughter, what does Alex write in that box?
The instructions mandate that he must enter zero, basically a -0. Because it was a gift, he received zero economic value in return.
And finally, in column G, he must enter the full name and address of the person who received the shares, his daughter.
So why does the IRS care so deeply about a father giving his daughter $0 shares?
That's the big question.
Because the form forces Alex to explicitly legally write down that he received $0 for this transfer. By doing that under penalty of perjury, the IRS legally binds him to categorizing this as a gift. He can't come back 5 years later during an audit and claim, oh, actually, that was a repayment of a loan to my daughter. He is locked in.
Oh, I see.
Furthermore, the IRS now has a perfect, continuous paper trail. They know Alex has 5,000 fewer shares, and they know the exact name and address of the person who now holds them. When the daughter eventually goes to sell those shares 10 years from now, the IRS will know exactly what her cost basis should be, tracing it all the way back to Alex's original 1999 purchase. The chain of custody is unbroken.
It completely eliminates the ability to make foreign wealth disappear by just handing it to a relative off the books.
Exactly.
Let's escalate the complexity and look at example 2. This is about massive corporate acquisitions and tracing chains of ownership. Let's imagine an investor named Mr. Lyons.
Okay, Mr. Lyons executes a deal to acquire a 10% ownership stake in foreign corporation F.
Right. But Corporation F is not just a simple standalone company making widgets. Corporation F is a holding company. F is the 100% owner of 2 other foreign operating companies, FI and FJ. Additionally, F is a 50% joint venture owner of Corporation FK. And on top of all that, Corporation F itself is actually 90% owned by a massive global conglomerate, Corporation W.
It is an absolute spiderweb of international ownership.
It really is. And to be clear, our U.S. investor, Mr. Lyons, does not own any stock directly in the ultimate parent, Corporation W. He just bought a 10% slice of the middleman, Corporation F. The IRS instructions dictate that because Mr. Lyons acquired 10% of F, he crosses the threshold and must complete Schedule O. But he doesn't just fill out the grids. The instructions state he is explicitly required to submit a supplemental chain of ownership chart.
He has to draw a picture for the IRS.
Yes. He has to attach a literal visual flowchart to his tax return. Why? Why does the IRS demand a drawing instead of just data fields?
If we connect this back to our earlier conversation about the matrix of ownership, this visual chart traces the exact path of the Section 958 indirect and constructive attribution rules.
Okay, so it maps back to the matrix.
Yes. The IRS demands this chart because human examiners need to be able to visually follow the bouncing ball. When Mr. Lyons buys 10% of Corporation F, he isn't just buying a piece of F. Because F owns 100% of FI and FJ, the rules of indirect ownership mean that Mr. Lyons just silently acquired 10% of FI and 10% of FJ at the exact same moment.
He executed one trade, but became a 10% owner of 3 different global companies simultaneously.
Precisely. And the IRS uses these visual Schedule O charts to track the movement of the most important asset of all, earnings and profits. Imagine a different scenario where a massive U.S. parent company decides to undergo a global restructuring. They take a highly profitable European operating company and they drop it down to become a subsidiary of a brand new holding company located in a zero-tax jurisdiction. To the casual observer, the U.S. parent still owns everything, it's just in a different order.
Just shuffling the deck chairs.
Right. But during that share-for-share exchange, did the billions of dollars of accumulated earnings and profits stay with the operating company, or did it somehow vanish during the merger accounting? Good question. The IRS uses the Schedule O chain of ownership chart to compare the before picture with the after picture. They lay the charts side by side to ensure that a multinational isn't executing complex reorganizations to create hidden pockets of untaxed E&P that permanently escape the U.S. tax net. If you restructure and suddenly $1 billion of E&P disappears from your global ledger, Schedule O is the map the IRS auditor uses to find out exactly where you buried it.
So Schedule O is the ultimate paper trail. It documents every single time the genetic sequence of the company schedules A and B mutates or adapts to a new corporate strategy.
That's a brilliant way to frame it. Yes, it is the evolutionary record of the corporation.
Okay, we have covered an epic amount of ground today. We started at the very surface, the strict, unforgiving face-of-the-form penalty checks, where a single missing checkbox in item B can stall the automated algorithms, invalidate the entire filing, and trigger a cascading series of $10,000 fines.
Definitely something you want to avoid.
For sure. We discussed the FSA and CCA memos that prove the IRS will not accept close enough as substantial compliance.
The machine requires perfect inputs.
From there, we dove deep into the family tree, the genetic mapping of ownership on Schedules A and B. We traced the mind-bending logic of Section 958 attribution, specifically the downward attribution where a domestic company can suddenly be deemed to own a foreign subsidiary simply because they share the same foreign parent-dragging sibling companies into the CFC reporting net.
The matrix of constructive ownership designed to prevent lateral tax evasion.
We tackled the heavy math of Schedule G, uncovering the new December 2025 OBBBA rules that eliminated the 1-month calendar lag to stop aggregate tax deferral. We explored the strict requirements of the divide by convention, rounding to 4 decimal places, and how multiplying instead of dividing could materially distort a financial statement, rendering the entire return substantially incomplete.
The devil is in the details, or in this case, the decimals.
True. But we also highlighted the critical lifeline provided by the Alternative Information Safe Harbor in Revenue Procedure 2019-40 for minority shareholders trapped without access to U.S. GAAP financials.
The necessary shield against an otherwise impossible compliance burden.
And finally, we tracked the corporate life cycle on Schedule O, documenting how gifts, acquisitions, and massive reorganizations require literal flowcharts so the IRS can track the movement of global earnings and profits.
It is a staggering amount of compliance.
It really is. Before we sign off, I want to ask you for a final thought. We've spent an hour discussing traps, penalties, and hyper-complex statutes. For the tax professional prepping for busy season or the CFO evaluating risk, what is the one overarching truth hovering over all of this that they need to take away?
Well, I want to leave you with a provocative thought that comes directly from the deepest corners of the penalty provisions we researched. It involves the statute of limitations. We all know that a standard U.S. income tax return generally has a 3-year statute of limitations. After 3 years, the IRS generally cannot audit you or assess new taxes.
Right, you can finally shred the old receipts.
But the text notes a terrifying exception. The statute of limitations on assessing and collecting Form 5471 penalties differs from that of the underlying income tax return it is attached to.
Wait, they aren't tied together? The Form 5471 doesn't close when the corporate return closes?
Not necessarily. I want you to ponder this scenario. Your standard corporate income tax return statute of limitations expires. You think you are safe. But 5 years later, the IRS is reviewing historical data, and they decide your Schedule O from 5 years ago was deemed substantially incomplete because you used the wrong functional currency conversion rate on a minor foreign subsidiary's income statement.
Oh boy.
Because the Form 5471 was deemed substantially incomplete, legally, the IRS considers it as having never been filed. And if a tax form is never legally filed, the statute of limitations on assessing the penalty for failing to file it never actually starts running.
No way.
Is that $10,000 international tax penalty hanging over your head forever? In many cases, yes. The statute remains open indefinitely. It is a chilling reminder that in the world of international tax, the past is rarely truly dead. It can always be resurrected by an auditor finding a single missing checkbox or a rounding error from a decade ago.
Wow. The past is rarely truly dead. That is a deeply sobering thought to end on. So, as we close the book on this deep dive into the labyrinth of Form 5471, remember where we started. The world of international tax compliance is not a clean binary X-ray where broken bones are easily seen.
Not at all.
It is a murky, endlessly complex landscape where the rules of constructive ownership create phantom liabilities and functional currency rounding can invalidate an entire year of accounting. Keep your organization charts meticulously updated, document every single shift in the corporate family tree, and whatever you do, make sure your exchange rates are divided, not multiplied, out to at least 4 decimal places. Thank you for joining us in the Deep End. We'll see you next time.